Picture this. The stock market is crashing. The news is screaming about layoffs. Your neighbor just lost half their portfolio. And there you are, staring at your bank account, wondering if you should invest right now or run for the hills. Here's what nobody tells you. The answer to that question will determine whether you build life-changing wealth or spend the next decade kicking yourself for missing the opportunity of a lifetime. My name is Ava, and today we're tackling the question that separates people who get rich from people who stay broke. Should you actually invest during a recession? And I'm going to warn you right now, the answer is going to make you uncomfortable, because what I'm about to share goes against every instinct your brain is screaming at you when the economy is falling apart. If you want to understand how wealthy people think about money during the times when everyone else is panicking, make sure you hit that subscribe button. And if this video changes how you see recessions forever, smash that like button so more people can find it. Let's start with the obvious. Investing during a recession feels terrifying, and your fear is completely valid. When the economy is tanking, everything in your primitive brain is telling you to protect what you have, not risk it. You're watching your coworkers get laid off, you're seeing headlines about companies going bankrupt, you're hearing stories about people who lost everything in the last crash, and every fiber of your being is screaming, this is not the time to be putting money into the stock market. But here's what's fascinating about recessions. They expose the difference between how poor people think about money and how rich people think about money. Poor people see a recession and think, oh no, everything is falling apart, I need to sell and protect myself. Rich people see the exact same recession and think, oh good, everything's on sale, time to buy. Same event, completely opposite reactions, and those opposite reactions create completely opposite financial outcomes. Let me be crystal clear about something. I'm not saying you should take the rent money and throw it into risky stocks during a recession. I'm not suggesting you invest money you can't afford to lose. That would be idiotic and irresponsible. But what I am saying is this. If you have money that you don't need for at least 5 years and you're sitting on the sidelines during a recession because you're scared, you are making one of the most expensive mistakes of your entire financial life. Here's the part that's going to sting. The best time to build wealth is when everything feels like it's falling apart, not when things are good, not when the market is hitting all-time highs and everyone's getting rich, but when everything is on fire and people are panicking. Warren Buffett has this famous quote, "Be fearful when others are greedy, and greedy when others are fearful." And that sounds really nice as a motivational poster, but do you understand what he's actually saying? He's saying the time to invest is when it feels the scariest, when your hands are shaking, when you're questioning whether this is a huge mistake. Let me give you some actual numbers that prove this point. During the 2008 financial crisis, the S&P 500 dropped about 57% from its peak. People were losing their minds. The world felt like it was ending. If you invested $10,000 at the lowest point in March 2009, that money would be worth over $70,000 today. That's a 7x return. But here's the thing. You didn't need to perfectly time the bottom. Even if you invested during the crash on the way down, even if you bought when things were still falling, you still would have made incredible returns over the next decade. Because recessions end. Markets recover, and the stocks you bought at massive discounts eventually go back up. The COVID crash in 2020 is an even more dramatic example. The market dropped 34% in about a month. People were terrified, and if you had the courage to invest during that crash, your money more than doubled in the next 2 years. The people who sat on the sidelines waiting for things to feel safe missed one of the greatest buying opportunities in modern history. So why don't more people invest during recessions if the opportunity is so obvious? Because humans are wired to do exactly the wrong thing with money. We have something called recency bias. Whatever just happened feels like it's going to keep happening forever. Market going up, we think it'll go up forever, so we pile in at the top. Market crashing, we think it'll crash forever, so we sell at the bottom or refuse to buy. We also have loss aversion, which means we feel losses about twice as strongly as we feel gains. Losing $1,000 hurts way more than gaining $1,000 feels good. So during a recession, when investments are down, that pain is so intense that we'll do anything to avoid it, even if it means missing out on massive future gains. And then there's herd mentality. When everyone around you is panicking and selling, it feels insane to do the opposite. You start questioning yourself. Maybe they know something I don't. Maybe I'm the crazy one for wanting to invest right now. But here's what you need to understand. The herd is almost always wrong at the extremes. When everyone is euphoric and buying, that's usually near the top. When everyone is terrified and selling, that's usually near the bottom. The crowd's emotions are the worst possible investment strategy. The people who build generational wealth are the ones who can override these psychological traps. They don't invest based on feelings. They invest based on math, fundamentals, and long-term thinking. So what should you actually do during a recession? Here's the framework I want you to remember. First, make sure your foundation is solid. You need an emergency fund. You need to be able to cover your basic expenses. If you're in a precarious financial situation where losing your job would destroy you, your priority is building stability, not investing. Handle that first. But once you've got that foundation, here's the strategy. Keep investing regularly, no matter what the market is doing. This is called dollar cost averaging, and it's the single best way to invest during volatile times. Instead of trying to time the market perfectly, which is basically impossible, you invest a set amount every month regardless of what's happening. Market up, you invest. Market down, you invest. Recession, you invest. When prices are low, your money buys more shares. When prices are high, it buys fewer shares. Over time, you average out to a good price. During a recession specifically, if you have extra cash and you're financially secure, that's when you should be increasing your investments, not decreasing them. This is when quality companies are trading at massive discounts. This is when future returns are highest because you're buying low. And here's the most important part. You have to have a long-term perspective. If you're investing money you need next year, you shouldn't be in the stock market at all, recession or not. But if you're investing for retirement that's 20 or 30 years away, these short-term crashes are completely irrelevant. They're just noise. Now, I need to give you a reality check. Not all investments are good investments during a recession. I'm talking about broad market index funds, diversified portfolios, solid companies with strong fundamentals. I'm not talking about speculative garbage, meme stocks, or whatever your cousin is hyping up on social media. During recessions, risky investments get even riskier. Companies with weak balance sheets go bankrupt. Speculative assets can go to zero, so you need to be smart about what you're buying. Stick with boring, diversified index funds like the S&P 500. These represent the entire market, so you're not betting on individual companies. You're betting on the American economy recovering, which it has done after every single recession in history. And remember, past performance doesn't guarantee future results. I can't tell you with certainty that the market will recover from the next recession, but I can tell you that betting against a long-term economic recovery has been a losing strategy for the past century. So, should you invest during a recession? If you've got your financial foundation solid, if you're investing money you won't need for years, and if you can handle the emotional roller coaster of watching your investments drop before they recover, then yes, absolutely yes. Recessions are where wealth is built, not by the people with the most money, but by the people with the most courage and discipline to keep investing when it feels the scariest. The next recession is coming. I don't know when, but it's coming. And when it does, you're going to have a choice. You can panic and sit on the sidelines like most people, or you can take advantage of the opportunity like wealthy people do. Your future self is depending on the choice you make in that moment. Choose wisely. If this video helped you think differently about recessions and investing, hit that like button and subscribe for more financial truth that actually matters. And drop a comment telling me, would you have the courage to invest during the next recession, or would fear win? I'm Ava, and I'll see you in the next one.